All right. Welcome, guys. Just trying to make sure my settings are proper here. All right. So first and foremost, happy Labor Day. Thanks for joining. Labor Day, I think it was a good time to put some work in during Labor Day. So I'm going to go over these. The point of today's live is really to do two things. Number one is to kind of go through the trades that I have open, kind of go through them. If anybody has any questions, as always, feel free to ask questions in the comments section and I'll address them. But the other main point is really to highlight tracking trades, right? And I have a particular Excel that I personally use. I've kind of put this one together myself, and it's very simple. I mean, I don't want to overcomplicate it. On the left side here, and I'll go through it, I track each individual option play. The yellow ones are puts sold, and the white ones are calls sold. It's very simple. On the right side here, it tells me all the times I've either bought or sold shares. So it gives me sort of the average cost per share. And then up here, it's just kind of a summary of what my adjusted basis is, and we'll go through this in detail. I have a tab open for each stock, and then I have kind of a generic one for shares that I kind of just dip in and out. We'll go into detail on that. I'm going to start with just the portfolio review, and then we'll go into Excel, and they'll actually play into each other, because what I'll do now is I'll explain to you the Excel, and then we'll refer to the Excel as we go through the trade. So that way you can see the logic and the return expectations behind each trade. So if we go to this Excel, it's very simple, right? So here, let me zoom in here. So let's go ahead and do it for SoFi, for example, right? So for SoFi, here I have the date that it was opened. And let me know if you guys can see this properly here. I'm going to zoom in as much as I can. So here I have the date it was opened, the type of share or the type of action it was. So I sold a put. When that put expires, my strike price, how many contracts I had opened, how much premium I got per put, per contract. So that's $29 per contract. And this is all formulaic already. So this total credit is just going to take the premium that I got, times it by the contracts. So that's $2,500 of potential credit. And I say potential credit because if you close it early, that's not the full credit you're going to get, right? Here we have the status, closed or open. So if I was to go ahead and delete this, it automatically switches to open. And that's good, because if I'm going through my trades, there may be a trade that it's a long trade. So I opened it a month or two ago, and I can see exactly which ones are the ones that are open or not. So that feature has been helpful. Date closed. So this section to the right of the closed is pretty much the closing of the option, right? So this particular trade, I closed it on the 12th of June, and I opened it on the 14th of May, right? So I already was about a month into the trade. The trade had about 2 weeks left because it expired on the 28th. For whatever reason, I decided to cut it close, or close the option early. And my closing cost was $13.64 per contract. So that's what they were trading for. So that means that I had to pay back $1,186. So I'm taking my closing cost plus the contracts. And again, this is all a formula. This is you just input the numbers and that's it. And it gives you a profit. So my profit for this particular trade was $1,380 in about a month. Here, ROI, this is a number that I pay a lot of attention to, just because it's a number that really, guides why we're doing this. If we're going through all this effort of picking calls and picking puts and trying to time it as best as we can, and we're not even beating the S&P 500, then what's the point? You might as well just stick your money in the S&P and call it a day and avoid all these issues, right? So the whole point is to beat that trade. And so you should have weekly or monthly return expectations that fit within your risk metrics, right? Because the idea is not for you to now go take some insane amount of risk. but that fit within the risk that you are expecting, this number is going to tell you a lot. So 1.61%. So that pretty much just takes what was my total collateral. So 700, which is my collateral requirement for the put, times 87, whatever that number is. And I divide how much money I made. So 1,380 divided by the amount of money required is a 1.6% return in give or take a month, right? So 1.61% in a month is about 20% a year. That is beating the S&P. I don't know if it is this year, but it's definitely a good return. And furthermore, I believe this trade was done with margin requirements. So that's a whole different episode, but essentially, quote unquote, this was free money. So the ROI is essentially infinite. But that's for the sake of what we're doing today, we'll avoid talking about margin. Okay, cool. So that covers kind of my tracker. So you guys know how to read it. Here it tells me here's all the shares that I've either bought or sold. Okay, so as a matter of fact, I believe I got 100 shares taken on the 2nd, so on the 30th, because I believe I only have now. So if we go to Sophie, right, it's at $8. And I believe I got my $8 call assigned. So I got covered call 5. I believe it was a $7 and an $8 that I got assigned that I haven't tracked on here yet. So I'm gonna go ahead and add it, because I only have 900 shares here, right? So that means that at some point, how many shares does it say I have here? 1,200. So at some point, 300 shares were taken away. And I'm trying to see exactly what were the last 300 shares that I sold here. And we're going to go ahead into our trade confirmation. So right here, you sold 100 shares at 800. So I got an $8 assigned. And then I also got it at, you've canceled your order. Right here, you sold 200 shares at, I was credited 1,500. So 1,500, it was 200 shares. So I got 2,750s assigned. Okay, so we're gonna go ahead and let's go ahead and add that to our Excel here. So we're gonna go ahead and sold, right? I believe it was the 30th. Got 200 at 750. So that's 500 off, negative 1,500 sold. And then I also got a negative 100 $8 one, right? So that essentially leaves me now with 900 shares. Now, there's a lot of questions around this particular cost basis. It really just depends how you calculate it. If Robinhood, for example, calculates it differently. If you go to my cost basis on Robinhood, it says it's 744. Now, this number 744, it depends on which, like if I sell 100 shares, is it going to apply it to the ones that I bought at $7, or is it going to apply it to the ones that I bought at $8? One of them is going to show a loss. One of them is going to show a profit. So I generally lean on my tracking just because I know it's basically, mine just mushes everything together, right? It takes into account everything I've sold, everything I've bought, and then it averages out what my basis is in the stock. So technically my basis is $10.60. Right? Because if you take into account, basically what this is taking into account is all the losses that I've taken. They're essentially adding those losses to the gains. And this would be sort of my break-even point, if you will. had I not sold any shares, this would have been lower. But because I did, this number goes up, right? Because all it's taking is pretty much saying, look, this is how much money you have in it right now, right? So if I was to add up all the money I put in versus all the money I put out and divide it by the shares that I have, this is sort of my break-even point, right? 1060. Now, what's very important is this little box right here on the top right. This is tracking pretty much all the profits from our option selling, right? So individual to what the stock is trading at, we've generated about $4,500 in option premium, right? So if I go ahead and take that, let me just update the shares owned here. So if I go ahead and update this, right? So right now what this top column is saying is my average cost per share is 1060, which we got from here. I have 900 shares, so my investment cost is 9,543. SoFi is at 799, so my market value is 7,000. So technically, quote unquote, I'm down 24% on this stock, right? But if we take profits to date and we redistribute it throughout the basis and the shares that we have, then technically my adjusted basis is $5.64, right? Because we're taking what my cost is, which is 9,000, we subtract 4, so we really have about 5,000 and change, which is what this basis comes out to, right? So this right here highlights the beauty of option selling because it saves you from making bad decisions. And look, I sold SoFi when I probably shouldn't have. You know, I sold a good amount of it. Look, 100, 300 shares, 500 shares when I was at 650, 629, 641. I sold it at a pretty bad time. You know, I sold 1,500 shares at 650. So option selling definitely covers your butt and helps you make a bad trade a winning trade. And to me, this is a winning trade because right now our adjusted basis is 564. It's currently trading at $8. All of that is gravy. And we'll get into where my positions are with SoFi because that's a whole different other issue. But so far, it's something that, you know, as long as it's a profit, as long as you're making money. Cool. So now that we've covered the Excel and we know how it works, let's start going through each position. So Intuit has been, this is definitely, so my whole ethos with this account is to grow it slowly, but confidently, right? Over time. There's no point in having a 30% year and then a negative 10% year the next one, right? It's just counter intuitive to do that if you're trying to grow an account. So the idea is to not take an insane amount of risk, take risk that you're comfortable with, that you're good sleeping at night. If you are okay putting away your laptop for a week and not checking your trades and you're okay with it, that's the kind of trades you should be doing. Okay. Every now and a while, I do take a little bit higher risk calls with a very, very small percent of my portfolio. So maybe 1% or even 0.5% of my portfolio. And sometimes they go the way they're supposed to go. And sometimes they don't go the way they're supposed to go. You know, like for example, one of the trades that I covered earlier, that was a high risk trade, if you will, was Melly. So Melly is sort of the Amazon of Melly is the Amazon of Latin America. And basically I left a lot of money on the table, but at least it was a winning trade. But I basically bought a call option right before earnings. So it's a very expensive option because the stock is a $1,700, you know, when I bought it. So I had bought a 1,680. Oh my God, that's insane. So I bought one at 1,680. So I spent $10,000 on this call, right? So right here, call bought, and I put it as a negative because I spent 10,600. Now, what I like to do with these options is I like to generate income while I wait for whatever catalyst it is. So while we were waiting for the earnings, which happened at the end of the month, I was selling calls on that long dated option. So for example, I sold one for $1,050 credit. So I sold a 1780 call. I closed it early for 380. So I made 670. I made 800. I made 85 on this one. I sold another one. I made 800. And then I made another 150. So my point is that while we were waiting, we made a total of 1,710. So that just reduces your cost basis, right? Now, I'll show you on the Intuit how this helps if the trade doesn't go your way. Luckily, this trade did go our way, and after earnings, I actually closed it out for $13,000. So I made $2,400 on the option itself, plus what I made on the premiums. So this was $4,100, right? So to make $4,100 on a $10,000 trade, that's close to 30-40% in a week. This was a phenomenal trade. Okay. Now, if we go to Intuit, which is the one that we're actually talking about, this is the opposite of that example. This is when a call option does not go your way, right? And I've been very transparent about this position. So what I originally did, and just to kind of highlight where I'm at in this process, I bought a call for their earnings. I bought a 690 strike price that expires October 18th. Okay. And I had bought one of them for a lot of money. So I bought right here, 2 buys. Let's look into these 2 buys right here. So I bought one for $2,400. Okay. And then I bought my second one after earnings, where the stock kind of dipped, even though earnings were spectacular, for $460. So you can already see how much value this lost, right? So my point in doing that is not to double down, but just to absorb a bit of that average, right? So technically my average is, I have 2 for 1,427, right? So my average comes down to $1,400 each, instead of one for 400 and one for 2,400. And so what I've started to do with this particular trade is I'm starting to sell calls on it, right? And even a put. So I'm playing both sides of Intuit, right? So what I've done is I sold 2 calls, generated $168, $200. I sold a put, $730. Another call, $155. A put sold, made $130. What else? A call sold that expired worthless, so I kept the $110. And then I have 2 positions open. I have a call and a put, right? So the idea right now is, look, I've collected $1,500 worth of premium, right? My total cost basis for both of them is $28.54. So if I was to take $28.54 and I take away what I've already made from it, I have $13.61. $13.61 divided by 2. That means that right now my break even on those call options is $680. You see, so you can see how I took a $2,300 loss from that option losing value to now generating a $680 break even point on the call. And right now it's at 500. So if I wanted to close this right now, you take 500 minus 580 minus 680. So I would be taking $180 loss per option contract. So give or take $300-400, right? So I just took a $2,000 loss to $300-400, right? And now remember, I still have on these calls a good amount of time left. So that means I'm going to continue selling puts and calls on this until I can either generate a win, or Intuit just decides to come back to life and continue moving up, in case those options will also continue to gain value, and it's a win-win. So that is, but again, this is considered a high risk trade, right? So right now, looking at Intuit, just to go through the shares here, my open positions, I have a 645 call open for 9.6. This one's cutting it a bit close. Again, I'm not worried because I can continue rolling these out, but something I will keep an eye on. I have a 615 put for the end of this week as well that I sold. I think I sold this for 510, so I'm already up 280 on this. And then I also sold, and that's it. So I have the ability on Tuesday, tomorrow, to sell one more call. And I purposely held off just to see how this reacts during the week. The last thing you want to do is get caught underwater with these, but it's a fine balance between generating enough income to offset your cost to not being caught underwater. All right, so that's that for Intuit. Tesla and TSLL, I'm going to leave for the end. Or actually, you know what? Let's get into it. Tesla, right? So Tesla is probably my biggest position. I have 1,000 shares of Tesla at 173. Now, where am I with it? So I have 8 calls that I've been caught underwater with, and I've been rolling them out to 205 in December. Obviously, the robo taxi event is going to be huge, whether this stock actually goes past the 220 kind of resistance it's at right now, or it goes back down. That's going to be very telling. But I'm very bullish on the stock, and truth be told, I really don't mind just keep on rolling these out for until I'm above water. So I'm not concerned about these. Right now, they're just kind of losing, it's extrinsic value. I'm just eating up time. You can already see I'm up 50% on these, $24,000. So this is just something I leave. So all these calls here, 8, 9, 10. So these 10 calls are part of my Tesla position shares, right? Separate to that, I opened up 2 credit spreads. So these are very high risk. I usually don't like to do credit spreads. Put spreads are a bit less risky, but credit spreads I'm not a fan of. If you don't know what credit spreads are, let me know in the comments, and maybe I'll do a video on just credit spreads. But essentially, it allows you to take a position with very small collateral. So the collateral requires is just the difference between these two, 170 and 160. So it's about $1,000. And it generated $223 on that $1,000. So that's like a 23% return. But you have to be careful, because if Tesla does go down to this amount, then you could very well. It's very difficult to roll these out on Robinhood, and you may have to take a very large loss if you're trying to roll them out. So I stay away from these unless you can afford to dismantle them. And that's a whole other thing that we'll talk about. That's I would consider that advanced. But dismantling credit spreads is something that allows you to save them on Robinhood. And but we can cover that on a different. I'm going to cover that on a different live, how to dismantle a credit spread. So because of Tesla, and because my upside is capped, right? My upside is capped because I sold calls at 205. Sure, I can continue rolling them out once it expires, but technically, if Tesla right now goes to $300, technically my upside is just a time decay, because 205 is already the ceiling. So what I did is, because I'm very bullish on Tesla, is I opened up 9 TSLL. TSLL is a leveraged Tesla ETF, right? So for every dollar Tesla goes up, this goes up $2. So I bought options. This is obviously a very risky play. My total cost on this play is $2,700, right? So 700 on a $200,000 portfolio is less than 1%, right? So that's the kind of risk that I take with these high risk ones, right? So these expire in March of next year. And so basically, I'm probably going to hold on to these until the robo taxi event. But essentially, you see them right here, right? So I don't know why it says closed here when it's actually open. Sometimes the formulas get weird. But so I bought 9 at 270. So my total basis is 2430. I've sold a couple calls. The last thing I want to do is Tesla goes up really fast. So you have to be very careful selling calls on a leveraged ETF. So my recommendation is don't ever sell calls on the full position, because even if you do get caught underwater, at least you have 2 or 3 or 4 contracts that will just completely keep riding the wave. So right now I have 7 that are under contract, or 7 calls at $10.50 and $11. So there's plenty of room to run. You just got to be careful, because sometimes you don't collect the premium. You have to be ready to let them get called away at that strike, and if Tesla does go, TSL goes to 11, my call options are going to be worth a lot more, and then I'll be okay kind of letting them go. So it's a game that you're playing, right? But this is where I'm tracking my TSLL. I'm also playing it on the other side and sold a put. So I sold 5 long dated puts for December for $7. Those are $100 premiums each. That's $500. Those are very long plays. One of those, just kind of forget about them. It's at 960 right now, and it's at 960 right now. So these $5 puts I feel very comfortable about. $7. So this is just one of those positions we just let run. Okay, cool. So we have TSLL. All right, let's talk about SoFi since we were just talking about it now. SoFi is one of those positions where, I've actually generated a good amount of money off of these, and it's just all profit from now on. Right now I have $7.50 puts expiring next week. Pretty confident with these. SoFi kind of broke out already of its resistance. It hit $8 and it held $8, which is impressive. I rolled out some 750 calls to $8, right? So yes, they're expiring January, but it's just one of those things where, if you do the math, right, that's why you have to be very important to do the math, because when you're rolling shares up, it's not just about the credit, it's about the appreciation that you get from the stock, right? So let me show you what I mean by that. Let's go to the wheel tracker. Let me see if I can find, okay, here it is. So these were actually $7 calls. Okay, so I had these $7 calls. And again, the importance of this wheel tracker is also to keep track of what your net premium gain or loss is, right? Because as you keep rolling, you're either making money or you're losing money. So here, when I first opened these, I opened these $7 calls for $14 credits. I actually had to close them for 48. So right off the bat, it's $170 loss. I rolled them, marked by next. I collected $51, right? So again, all for, I guess, quote unquote credit. So I opened them up, I rolled them up, same strike price, but just rolled them out further, $51 of credit. So I collected $255. I ended up closing them for $115 per contract. So that's a $575. So that's a loss of $320. So right now with this contract, if you will, I'm at a loss of $490. Right now, I have two options at the end of here. I could have let it expired and just collected this full 575, or I'm sorry, I could have collected this full 255, right? But you're letting them get called away. So you let them get called away at 7, but you're making 255, right? So if I was to do that math, right, 7, so it's $7 strike price times 100, 5 contracts is 3,500. 3,500 plus the premium that we would have made, which is 255. So I would have made 3,755. 3,755. That would have been my total profit had I let them called away. But I said, no, you know what? I'm going to hold on to my shares. I believe in it. Let's do the math to see if it makes sense for me to roll it out further out. So I rolled them out to $8, right? So remember, between these two, I kept the same strike. So there's no share appreciation. But here, there's a share appreciation from a whole dollar, right? So yes, it's out till January 17th, but let's see what the profit is and see if it makes sense, right? So if I was to sell it at $8 plus 500, sorry, 5 contracts at 800, that's 800 times 5. So that's 800 times 5 contracts. So that's 4,000. 4,000 called away. Plus I keep the premium. So that's 590. So that's 4,000 plus 590. That's 4,590. Okay. So this would be my total profit if I waited. This is January, so it's September. So September, October, November, December, January. So let's say 5 months, give or take. Right. So assuming, right, let's use this as our cost basis, because the idea is, okay, if I had that cash, if I got that cash back and I let them get assigned, can I find a better use for that money to generate more than to just leave them there, right? That's really the question you got to ask yourself. Is it better to just leave them here or take $4,000 and redeploy them on puts sold or whatever your other strategies are? So the question is, for this extra, what is it? $835. in 5 months, what return is that, and is that sufficient for me? So I'm taking 835 and I'm dividing it by the 37.55 because that's kind of my original cash basis, if you will. And that is 22% return. So 22% return for the 5 months is an equivalent of 4.5% a month. So my question is, without doing anything, am I okay generating 4.5% return per month? So 22% return till December, till January, without having to do anything. With that being my absolute best case scenario. And my worst case scenario is that it stays under 8 and I just keep all that premium and just continue selling calls. So obviously my answer is absolutely yes. And so that's why I did that trade. 10 sells. I just obviously the 10 750 puts I sold. I have one option contract for $10 expiring in January. And I also rolled out these $7. So same exercise, right? And I believe those were 650s. I have them here. So I create little boxes when I'm doing rolls. So that way I can keep track of the premiums. So the one that we are talking about now is this one right here. So it was same exercise, just lower, way lower basis, right? I went from 650s to $7. And look at the amount of premium we've kind of accumulated. This one was actually closed at a profit there, if you will. But anyways, long story short, that's why you have to track your trades, because that is the only way that you can make these informed decisions, right? And your job as TJ the Wheel Deal likes to say, you're the CFO of your portfolio, and your job is to maximize your returns and minimize your risk. That is your absolute goal. So going back to this $8 example, you know, SoFi is obviously a company that is going to react favorably to these rate cut decisions, right? So you're on a good train to ride for the foreseeable future. So why not lock in a 22% gain while you still can, you know? And let's just say, for the sake of math, that it doesn't go be above $8 and you have to and you just keep the premium. You know, you keep the shares because it was below $8, but you keep the premium. You know, if we look at what our adjusted cost basis is for the shares, it's 564. So if I do 564 times 500 shares, that's 2820. So 590 divided by 2820 times 100. You know, that comes out to a 21%. So even on our premium, keeping our shares, just the premium alone is already a phenomenal return on our basis. You know, and if you wanted to do the math on opportunity costs, right? So if you let them get called away at $7 today, so let's just pretend our basis is $700 today. That's really 700 times 5 is 3,500. So you do 590 divided by 75. Was it 7,500 divided by 500 times 7? It's about a 16% return. So any way you look at it, it definitely makes sense to hold on to your shares. All right, let's continue going. I don't want to take too much time here. For those that don't know, let's look at my year to date so far, up 35%. I was clearing about 40. My goal is to really clear this 200. I've been kind of dipping at it, so I want to just completely go over it. That's my goal for the next couple weeks. All right, so we covered SoFi, TSLL. We covered this. Amazon is just another one of those, very small experiments that I do with buying long dated calls and selling calls against it. I like it because you get the full premium, but your cost base is very low. Only works if the stock continues to move up and right. Otherwise, the underlying call loses so much value that it doesn't make sense. Or buy them really, really long out. You know, if you buy them long dated, if you buy leaps, the theta, the amount of value the option loses as time goes by is so minimal that it actually makes sense for you to generate income from the premiums, you know. So that's a whole other strategy. That's called the poor man covers call. I know TJ the Wheel Deal has a very small part of his portfolio in that sort of. If you actually go to his Twitter, I think he posted a lot of his leaps. It's an interesting play. I mean, it's something to definitely incorporate into your portfolio. Riot. So I have a couple puts that I've sold. I have expiring next week. I have $7 puts and $7.50 puts. Palantir, I have a $28 put. You know, with Palantir, I've actually been doing pretty fun stuff with it. Obviously, Palantir is doing phenomenal. You know, 31.55. So what I've been doing is I have only 100 shares of it for $27.84, right? And so what I've wanted to do is kind of time it, right? And obviously the idea is to just to keep rolling your calls out of the money. But what I've been doing is I've been doing this thing called premium banking. And the reason you do premium banking is because you believe the stock is overvalued and it's going to come back down. So you try to capture as much as that premium in that elevated price as much as you can, right? So I had, for example, a $30 call, which I could have rolled to 31, 32, but I actually decided to start rolling down to 29, 28. So, you know, right now I have a $28 call with 439 premium. So, and I've already generated 165. So technically 439 divided by 100 is, you know, $4.39. So right now my basis, if you will, on this call is 28, 29, 30. It's $32.40, right? So if I let it get called away, it's almost like I'm selling them at cost. Plus I get to keep this 165. So I'm not concerned about it, but I am trying to time. I do think eventually that stock's going to retreat to the 25s, 26, 27s. And I'm just trying to bank as much premium as possible. Maybe what I'll do is actually I'll roll it back up. You know, I'll start rolling it back to 29, 30. I'm not really trying to let go of these shares. So that's really my idea. At the same time, I've been selling puts on it. So I have this $29 put sold, minimal premium, $10. You know, it's just something I like to do. I like to play both sides of my options. You know, if I sold a covered call at 28, I'm going to sell a put at 28. So that way I either make the put premium or I sell or I get or have to roll the call. You know, one of them hits. That's how you sort of guarantee a win. All right, so we've got Riot, Palantir, Intuit we covered, Tesla we covered, SoFi we covered. Look, that's pretty much it. These are my positions. This CleanSpark is one that I kind of got caught underwater. I was selling puts on it at 17 and it just crashed to 10. These are all very Bitcoin performance based. Now, another example with CleanSpark though is while obviously my cost basis is very high, I collected about $3,000 in premium. So technically my basis is $13.91. So my goal right now is to wheel this until this gets $13.91, $14, and then just completely close out that position. I'm not really big into Bitcoin miners. I'm not really big into cryptocurrencies, to be quite frank. That's a story for another day. But long story short, I do want to get out of this CleanSpark position. It's sort of my only sore point right now. So that's pretty much it. If you guys have any questions, got TJ the real deal here saying what's up. Oh, I'm showing everybody the screen. You look like John Travolta with that hair. Appreciate it, my man. You know, that's another long-term goal is to keep it. All right, guys. So that's pretty much it. Thank you guys for watching. If you have any questions, feel free to leave them on my YouTube or my X channel. what I intend to do with this channel, just so you are all aware, is I really want to do these portfolio reviews because I believe that learning options is much like riding a bicycle. You know, you can watch all the tutorials that you want on riding a bicycle, but at the end of the day, you got to put a foot on the pedal, and you generate this sixth sense for what feels right and what doesn't feel right. And the only way to do that is to jump in. So that's why I like to do these live portfolios, because you can see how you sort of wrestle, or you sort of you know, like how we covered with Intuit, how you kind of manufacture a win, like TJ likes to say. And that's probably the most important thing with option trading, is manufacturing that win. So that's one of the main things. One of the other things I'll probably start doing in the coming weeks is I have a set of rules that I stick to, a set of rules, trading rules that have helped me tremendously and I've learned over a long period of time. And I'd like to share those with you, and we can discuss them and speak about them. So what I'll start doing is, in the future live streams, I'm going to start sharing one rule with you as each live stream goes. So anyways, thank you all for watching. Enjoy your Labor Day. Enjoy your day off. Tomorrow the market opens back up, and I will see you guys around. Make sure to follow me on YouTube, on X, and if you have any questions, I'm very accessible. Thank you guys.